to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Uncertainty, it definitely fuels a more difficult environment to make investment decisions. But that's the whole reason why institutions and now wealth management platforms have been embracing alternatives, because in times like these, where you have not necessarily a bust like the pandemic period or 22, but certainly more heightened uncertainty, that's when you can look to alternatives to provide more consistent returns without all the wacky volatility and uncertainty.
I might not be aggressive in buying, but I certainly have not been selling during this period. I do believe in these business models that, personally, I've spent time trying to understand. It's a long game when you talk about that type of investment thesis.
We think copper will follow a similar trend to what steel has done, which is ramp on the back of tariffs. The big issue that we see is that on our trading ranges is getting close to the top of the range. And so there might be some limited room here to grow. But the one thing that I'll caveat that is we're expecting to see a large stimuli from Europe and China specifically.
We got 1 hour to go until the market close. So let's take a look at the major averages here today. And we are reacting to tariff headlines once again. In this case, we're expecting at 4 p.m. President Trump to make an auto tariff related announcement at the White House. But we don't know exactly what these auto tariffs are going to be. We don't know who they're going to affect, who they might exempt. In any case, here's more uncertainty for the market. And so the Dow right now is down 227 points, about 0.5%. The S&P 500 is down 1.3%, and the NASDAQ is down 2.25%. And here's sort of the irony. It's not the automakers that are falling the most. It's the sort of growthy momentum names that are falling the most.
Yeah, we had that nice bounce, remember that? But now, to your point, we got tariffs, we got uncertainty. Trump is expected to announce these tariffs on the auto industry. To your point, Julie, I think a lot of what's going on right now is you just don't have much meat on the bone at all. You got a headline about tariffs, but you don't know the specifics. You don't know the level of the tariffs, the scope of the tariffs. Could there be exemptions? Could there be carve-outs? What's even the timeline? Even if you got an announcement today, when would they be implemented? So all this breeds this uncertainty, and you're back to these big questions about, well, what does it mean for inflation, for the economy, for the markets? Coming on the very day, by the way, which Barclays made some waves, some headlines. You got a smart group over there. And they cut their target on the SPX this year to 5,900. And in part, what were they talking about there? They were talking to their clients about tariffs.
Yes, and you also comes on the same day that Fed official Alberto Musalem in a speech talking about he's not convinced that the impact of tariffs will be temporary. He talks about the sort of secondary effects from tariffs maybe lasting longer and maybe feeding through into inflation. So there's a lot for investors to weigh here today. Let's first take a quick look at the 10-year here to see how it's reacting to all of this. We are seeing a little bit of an increase, not a huge one, but 3 basis points higher there. And then, as I mentioned, what we're seeing is this sell-off kind of concentrated in the momentum names. NVIDIA, by the way, falling on some reporting out of the FT that maybe could be some more restrictions related to China that could affect its business. It's down by 6% on that. There was another note on Microsoft potentially canceling or delaying or deferring some of its data center leases. So there's a lot for investors to digest with big cap tech, and they're selling it.
They are, for sure. Let's get to the story of the day, though. President Donald Trump set to unveil, as we were just discussing, new tariffs on auto imports in the next hour. Shares of General Motors, Ford, and Stellantis, they are all lower on that news. And our next guest is reporting that leaders at GM and Ford have been in ongoing talks with the administration to try to strike an 11th hour deal. Joining us now is Jamie LaRoe, Detroit Free Press automotive reporter. Jamie, it is great to have you on the show. So, Jamie, I don't know if you heard, I was just talking to Julie there. Obviously, the headline of the day, Trump expected to announce these tariffs on the auto industry, but we are left with so many questions, Jamie, right? We don't have a lot of details at all right now about the level and scope of the tariffs, about whether there were carve-outs, about even the timeline here. But you know these names, Jamie, you know this sector, so I'm curious, just broad take, your reaction to these headlines.
Well, that's exactly accurate, that there's still a lot of uncertainty. And as a result, many of the companies are paralyzed in terms of what they can do in terms of product planning, parts, shipments, everything along those lines until they get some clarity. And to your point, will we get clarity or won't we? How specific will whatever is announced at 4 or 4:30 today be in terms of allowing these auto companies to make plans going forward? Will we know exactly where the tariffs are going to be applied, where they won't be applied, how long they'll be in place, when they go in place, all those questions. Hopefully, we will get some answers, because until that happens, so many suppliers tell me that they've had product plans frozen from the automakers and from their clients because they just can't make plans till they know what it's going to cost them.
And as you reported, Ford Exec Chair Bill Ford may be heading to Washington at some point this week to have some discussions with the White House. GM CEO Mary Barra attempting to get a channel there as well. You know, what are you hearing that their message might be? Short of avoiding all tariffs entirely, what are they trying to sort of nudge the administration then in the direction of doing? If not exempting them entirely, what would be another sort of better case scenario?
My understanding is the conversation has centered around finding ways to mitigate whatever impact those tariffs might have on these companies. So, for example, if there might be some way around it for automakers to get maybe credits or something like that, if they have a certain number of employees in the United States or something. Any kind of suggestions or anything that they can do to try and just thwart some of the impact that the tariffs would have on their companies. That, from what I understand, at least with Ford and GM, that there's a willingness there to relocate whatever product they can to the United States. They already have a number of facilities and manufacturing in the US. So building new plants is very expensive. It takes a long time. It can't happen in the next year. It can't happen in the next 2 years. It would take several years and several billions of dollars to do that. And the administration just doesn't seem to have the patience for that at the moment. And I think some of that might be the holdup.
What, Jamie, could a move like this, these kind of levies, these kind of tariffs, what could they mean for auto prices potentially, Jamie? Now, are these car companies, would they eat the costs? Are they in a financial position to eat the costs? Or no, pass it on to Jamie and Josh? Or would it be maybe a mix of the two?
The understanding is a lot of it would get passed on, and here's the reason why. First of all, the suppliers don't have the margin to absorb a 25% tariff. So they've already been going to the automakers and asking them to start paying more, to offer them more for their parts, which is difficult because they have a contract with the automakers. So the automakers in that contract are, held to paying a certain price, and they don't want to pay more, and they can't really pay more without pushing up the price of the vehicle. The experts have given a price increase range for consumers anywhere from, on the low end, $1,000 up to $9,000 more for a vehicle. So it's not cheap. Today, Cox Automotive put out their report that they're now anticipating auto sales will drop by 700,000 units this year, just based on what's happened in these last few months. The volatility, the uncertainty around tariffs, and just the economic scare of it has already now dented the auto industry sales for the year.
That is a lot of cars that might not get sold. Jamie, thank you so much for your time. Appreciate it.
You're welcome.
Well, another tariff headline from the White House, another sell-off on Wall Street. The selling accelerating in the final hour of trading. We're now at the lows of the day. Joining us now, Rick Reed, our BlackRock Global Fixed Income Chief Investment Officer. Rick, fantastic to see you here today. As I noted earlier, we got stock selling off. We got yields coming up, but not a huge move on the fixed income side there. What do you make of these latest tariff headlines, and what do you make of the general sort of sensitivity and reactivity of markets to these headlines that have been coming out so fast and furious over the past couple months?
So, I mean, you rightly have been talking about uncertainty. Markets hate uncertainty. And so, by the way, I always find that markets can only do one thing at a time. It's like we're talking about tariffs and like there's nothing else. And they're like, we've got to react minute to minute. And, there is so much stuff happening economically there. And so there are a couple of things that I think are away from tariffs. And, this is creating some uncertainty. And the fact that the president of the administration is willing to take a little bit of a transition period to determine, to make some change. You don't know how far that will go in terms of the economic impact. And one thing that we're following very closely, if you look at, I was looking at today's CEO confidence data, and it's dropped like crazy. And you think about where we came in at the beginning of the year as animal spirits, and now it's dropped. And by the way, it'll come back. But for the time being, one of the things that will impact the economy is, will companies hold off on CapEx, on M&A, on R&D spend? And the consumer is slowing down a bit. Consumer will come back because the consumer spends based on wherewithal as opposed to sentiment. But you got to be careful. And, the data over the next couple of months, one of the things that markets are reacting to, if you're a corporate CEO, by the way, if you're an investor, you say, you know what, I'm going to step back for a bit. I'll reduce a little bit of my beta, a little bit of my volatility in the portfolio. I just want to watch things play out. And we're in this period of stasis where everybody's just sitting on their hands for a bit of time, including when you go to trade in the markets, the liquidity is terrible. By the way, not just in down markets. When the market was rallying in a precipitous way in Friday and the beginning of this week, it's the same way. The liquidity just is, it's easier in an up market, but it's still pretty thin.
I just want to zero in on one thing you were talking about, which is CapEx, because today we did get CapEx numbers for February, and those core CapEx numbers down 1/3 of 1%, which was an unexpected decrease. Now, these are volatile numbers, right? You can see that from the chart, even how volatile these numbers can be. Nonetheless, is that potentially the beginning of that downturn in the sort of so-called hard data that a lot of people have been looking for?
Julie, I mean, if you actually track in the last 2 or 3 weeks, part of the reason why the rate market is backed up, the hard data away from, there's some bits and bobs like you talked about. The hard data has actually been pretty good. It's the sentiment stuff. It's the ISM surveys, it's consumer confidence, it's UMich confidence. The surveys are pretty rough. The hard data has been pretty good, but like you say, if you start to see some bending down of the hard data, that gets people concerned. Listen, I don't think we're going into recession. But for the next few weeks, with companies sitting on their hands, with people waiting, you're not going to have, so the next few weeks, maybe the next couple of months, you're not going to have a lot of data that will refute the recession thesis. So, it's part of why you got to manage your risk over the next couple of months. I think when you get to the other side, I think you'll see the economy that's in good shape, economy that's service-oriented, it's much more stable. But I think for the next few weeks, you gotta be on edge a little bit.
So against that backdrop, Rick, where I have this, I have volatility, I have, okay, as you're pointing out, the economic data looks solid. Maybe you see some softening there. Against that backdrop, what does that mean for portfolio construction, Rick? I'm an equity investor. I'm listening right now. What am I screening for?
So, I mean, the first thing is, we have, and I'm sure others have, you pull back on your beta, you raise some cash, you do some things like I did today around trying to get convexity in your portfolio. So the markets will come back.
Tell people what convexity means, Rick, sorry.
Yeah, so I like, when markets go down, I like to buy upside. As people freak out, they get nervous about things, it's a good time to buy upside. One of the ways you take, you build cash in the portfolio, but then you build some upside because there's a good chance that all of a sudden tariffs are described, which everybody's nervous about. And then once the data, I found that people don't like to take risk into the event. But once you see the news, almost no matter what it is, you get this relief and money gets put to work. So I like to buy some upside, particularly when markets go down. But I think in the interim, by the way, you think about in portfolio, look at what, like you were saying, what's happening to rates today. Rates are moving higher. Treasury's got to issue an awful lot of debt. The Fed can't move because inflation is still high. So what do? Gold is a pretty good hedge. Cash is a pretty good hedge. But the best hedge is just own less of what's volatile.
I got to ask you another big picture question too, Rick, because I think we haven't talked this year. And the last time you and I sat down and had a really in-depth conversation was a few days after the election at our big Invest conference. And not only you, but pretty much universally, the folks we talked to there were very optimistic, right? We're talking about this pro-growth administration that was coming in. CEOs were optimistic. The business world was optimistic. And, then, and President Trump talked about this sort of golden age coming for the United States. Is that golden age sort of now just deferred? Is the idea of it dead? I mean, the vibe right now couldn't be more different than it was at that point when we spoke.
Was that a few years ago?
It feels like it.
So it's a pretty incredible. I don't think I've ever seen in my career animal spirits moving to animals in hibernation as quickly as that has happened. And so what do I think is, listen, the president, I think the administration has described a willingness to go through a transition period to get to the other side. And by the way, I think there's some good things that are going to happen. But I think we got to get to the other side, and this willingness to transition. At the same time, the Fed's not going to put a lot of foam on the runway, as it were, in terms of lowering rates because inflation is high. So we're in this period. I think that same cash that's on the sideline on the investment side, cash that companies are sitting on, that money will get spent. It's just being postponed for a bit. And like I say, I think people realize the U.S. economy will be just fine. We just got to get through a period of uncertainty until we get there. If you're running a big company, you've got cross-border flows, you've got distribution channels, you've got M&A you could do. All that stuff is, you got to just wait for a bit. And so I don't think it's gone away. I just think it's in hibernation, as it were.
Rick, what's your advice to fixed income investors who are listening right now?
So I would go back to the gold, and I've talked about it. Like, this is, I don't think rates are going very far because of where the Fed is. You can build income in a portfolio. We have this ETF called BINC, and the flows continue to be very, very good. We can build a 6.5% portfolio. You can build about that, not extend that far out on the yield curve, clip a lot of coupon. Credit quality is as good as it's ever been because companies have, post-COVID, have termed their debt out. I would take income, stable income. Think about it. If you can hit this year 6.5% type of yield in return with an era where the equity market's moving around like it is, stability, income are pretty attractive. And I would just, I think it's the golden age of, like, for years we had to buy high yield at 3.5%. Now you could buy assets because the Fed can't move the rate down and the ECB is going to be slow moving the rate down. Income and stability are pretty exciting things, and because they're not that exciting.
And do they become even more attractive given the prospects for the fiscal picture in the U.S., which is something you and I also have talked about in the past, Rick? Because while this tariff stuff is going on, next up is all the tax stuff that's going to be going on, which inevitably is going to boost the U.S. deficit, right? We just learned today from the Congressional Budget Office that we have until August or September at best, until the Treasury basically runs out of money. We have to have the debt ceiling lifted. So all of these other cross currents are going on as well.
So I don't know how long we have, but you hit on the biggest issue. Listen, there's too much debt, and the amount of debt we're rolling over is too big. What the administration is trying to do is, like, we got to get spending down. We got to get the debt under control. Sometimes you got to bite the bullet a bit to get there. Sometimes you got to stub your toe a little bit in terms of, I don't really love this, but in the long run, it's gonna be helpful. So, listen, that's part of why I think, like, for now, I just want the income. I just want to stay generally in the front end of the curve. And I just want to be stable for a period of time. And then ultimately, that creates a much better dynamic on the other side. But like you say, the biggest risk is there's just so much debt. And not just debt, the debt service. The Fed can't bring the rate down. So the debt service builds. So I know we just got to deal with that. And by the way, I applaud the willingness. And for the first time, I would say, when you speak with public officials across the board, administration, congressional, people realize, like, this is a big deal. We need to address this, and it'll be very healthy if we do it effectively.
Well, Rick, we'll see if they're still singing that tune as they're trying to cut taxes and not just extend the tax cuts. And we'll check back in with you then to see how the markets are reacting to all of it as well. It's great to see you. Thanks for being with us.
You too. Thanks for having me.
We're just getting started here on Market Domination. Coming up, shares of Tesla lower today, on track to snap its recent winning streak. We'll speak to an analyst on the other side who's staying bullish on the EV maker despite uncertainty. Stick around, much more Market Domination still to come.
President Donald Trump is unveiling new tariffs on auto imports later this afternoon. The announcement coming as Tesla stock sees more pressure today. Our next guest is still bullish on Tesla, reiterating his buy rating on that stock. Joining us now is George Gianarikas, Managing Director at Canaccord Genuity. George, it is great to see you. So I do want to start on the news of the day, George. Tariffs. Trump expected to announce these tariffs on the auto industry, speaking to us apparently from the Oval Office at 4 p.m. Eastern. You cover, of course, George, the Teslas, the Rivians. You know this industry. You know the sector. Just your reaction, George. I'm curious. You see that headline. You see that news. Possible impact as you see it and ripple effects.
Look, we've been waiting for something for months. And what I can say about Tesla specifically is that we feel that relative to the rest of the industry, they'll be pretty well insulated. Now, there'll be an impact without a doubt, depending on what it is. But Tesla, for example, makes their vehicles in the United States for the United States. They source a lot of their parts within the country, and specifically around, for example, battery technology. The batteries that they use in the Teslas for the United States are also made in the United States. Now, some of the cells, the battery cells that they use for their energy storage, or all of them, are used from China, so there'll be an impact there. But we'll wait and see. Our view is that relative to the rest of the industry, they're in good shape.
So, George, let's then take a step back and look at the bigger picture, as you did in a recent note after you had a recent visit to one of Tesla's facilities outside Austin. And, you acknowledge some of the brand issues that the company has had, but you think they can come back from them. I guess my question is how, and are they even trying from an image perspective?
It's a great question. So, first and foremost, there have been a ton of headlines this quarter that would suggest that Tesla sales are tanking. And our view is that it's not time yet to determine whether or not there's been a brand impact. And I'll tell you why. When the company first reported its fourth quarter earnings, they were very specific in telling Wall Street that, look, we're going to take down our lines this quarter because we're getting ready for the new Model Y and other vehicles that we'll announce this year. And so some of the stuff that you're seeing in headline sales from Europe, maybe some sales from the US impact, that's been due to the supply issues that they talked about in their fourth quarter call. In addition to that, if you're going to buy a new Model Y, which is really nice, by the way, you're not probably going to want to buy the old Model Y. So there's been an element of people waiting. Now, to the extent there is some brand impact, we'll see. It'll happen, if it's going to happen at all, in Q2, Q3, Q4, as these dynamics wane. So the first quarter dynamics. So we're not so sure if this is the quarter where people can determine if there's been a material, huge brand impact yet. We'll wait and see with the rest of the market. And to the extent there are other new vehicles in the lineup that get introduced, we as bulls are hoping that will outweigh the impact of any brand damage.
So your point, George, I'm just to make sure I have line of sight here. Your point is it's less the branding and the politics. It's more of the something much more basic here. It's the Model Y switchover, changeover. That's what's impacting deliveries.
Exactly, at least for this quarter, right? So we were, for example, right after the company reported, our delivery estimate was 331,000, okay? And the street was somewhere above 400. We have a survey every quarter. We look over about 40 countries where we get publicly available data. We put it together in our database. We make some estimates as to what's going to happen in March. And we actually had to raise our estimate to 361. Now, we'll see where they actually end up. But ultimately, if you listen to what the company said, and then you watch what's happening in March so far, it's actually played out just like that. March numbers have improved significantly. That may be because the weather's a little bit better, but mostly it's because the new Model Y has been introduced and people are lining up to buy it.
George, what would change your mind? What would say to you, okay, it is brand damage, okay, it is affecting deliveries. What do you need to see?
We're certainly open to that. I mean, clearly we're all seeing the headlines in the news and a lot of protests and other things happening. So, for example, if the rest of the year takes place and we continue to see very weak Tesla sales, that'll certainly change our mind. In addition to that, there are other things the company's trying to put in place, right? So they have full self-driving. They have an unsupervised full self-driving launch in June in Austin. They're going to be cyber cabs out in the marketplace operating without a wheel and without pedals. Company is incredibly confident that they'll get that done. but it's not June yet, right? So we'll wait and see how that goes. In addition to that, there's Optimus, and that's obviously a lot longer term, but to the extent that they can't get that ramping, that'll change your mind. So there are multiple reasons, but our strong view is that this is not the quarter where you can make that assessment yet.
All right, wait and see. George, thank you so much. Appreciate it.
Thanks for having me.
Now time for some of today's trending tickers. Let's start with Dollar Tree. That stock is up today. On the news, it's selling its Family Dollar business to two private equity firms. Joining us now with more, Yahoo Finance's Brooke DePalma. I remember when there was a bidding war for Family Dollar, and now they're getting rid of it.
Everybody wanted it, and Dollar Tree actually won that bidding war against Dollar General. They bought it out for $9 billion, and now thinking about what it sold for today, $1 billion to two private equity firms. Investors applauding this move by the company, wanting to say Dollar Tree to get rid of Family Dollar for quite some time, as Family Dollar really struggled to stay relevant in this time when Amazon and Walmart continue to gain share. CEO Michael Creedon told investors on a call this morning, quote, "I strongly believe selling Family Dollar and returning to our roots with an expanded assortment at Dollar Tree has created material value. 2025 is going to be a transition year as we pivot to operating Dollar Tree as a standalone entity." Now, keep in mind, this will hit earnings for the full year by roughly 30 cents to 35 cents, but many investors calling this the right strategic move, saying that Family Dollar has been a consistent weight on top-line performance, margin rates, and management time. We now know the Dollar Tree will aim to focus on new formats, including these multi-tier offerings, so more prices being offered at stores, and so certainly many on the street applauding this move.
And tariffs front and center today, again, of course. I'm just wondering, Brooke, did Dollar Tree have anything to say about that dynamic?
Yeah, discount retailers, dollar stores, certainly top of mind within this tariff negotiations, this tariff discussions. They did say they were able to take action to offset 90% of incremental costs for the first round of tariffs. Like, keep in mind, that doesn't include the outlook when thinking about the second round of tariffs. But some of ways that it was able to mitigate those include changing items, negotiating with suppliers, eliminating some products entirely, and also they're really doubling down on that multi-price point offerings. So essentially something that's $2, $3, $5 instead of just that $1 strategy. But of course, now all eyes on April 2nd as those reciprocal tariffs will come into play here. They then said that they'll have to keep that top of mind and once again use those tools to mitigate that impact yet again.
Yeah, we'll see.
Right. Thank you, Brooke. Our next trending ticker, Microsoft. That stock is moving lower today after a new note from TD Cowen analysts revealed the tech giant has abandoned data center projects set to use 2 gigawatts of electricity in the U.S. and Europe in the last 6 months due to an oversupply relative to its current demand forecast. What's interesting, Julie, about the note is, so they say that, yes, Microsoft walked away here from new data center projects, right, U.S. and Europe, but then they also talked about how other hyperscalers kind of stepped in.
Yes.
That Google stepped in, grabbed some of the leases, and also Meta, by the way, they say also stepping in and grabbing some of that free capacity.
Yeah, so that there's not necessarily implications for the data center operators, right? It's more a question of getting the big picture of what's going on in AI. I thought one of the interesting things they said was one of the reasons that Microsoft pulled back was because it decided to not support incremental OpenAI training workloads. I don't exactly know what the implications of that are, but I just thought that that was sort of intriguing. The other thing that I thought was interesting is they talked about as NVIDIA continues to develop its plans for next generation data centers, that there is a little bit of a holdback on making purchasing decisions until it's clear what the next sort of NVIDIA iteration is going to look like. You know, why make all the plans now, order all the equipment, order the space, if you don't yet know exactly what you're going to need because you don't know what the NVIDIA system is going to look like. So they talk about that a little bit too.
And by the way, just speaking of AI, you see this Bloomberg report that hit this afternoon. They cited a source familiar on OpenAI. Expects the revenue was going to triple to $12.7 billion this year. And then they say and the revenue is going to continue growing at a fast clip, more than doubling next year to $29.4 billion. So fast up there. The bottom line, though, that here's just one more thing. I mean, obviously, hey, listen, those chips, those data centers, they don't come cheap. So again, this is Bloomberg citing a source. OpenAI does not expect to be cash flow positive until 2029.
2029.
Yeah, a year when its projected revenue, though, tops 125 billion. There you go.
This stuff is really expensive. All right, our next trending ticker is Paychex. That stock is moving higher today after the payroll and HR software provider saw first quarter earnings in line with expectations. It had $1.5 billion in revenue, adjusted earnings per share of $1.49. The company also noted its pending acquisition of rival Paycor is expected to close in April. And Paychex is an interesting one because it could be seen as a labor market proxy as well. So doing okay here. And most of the analysts saying this was pretty much in line with expectations. So if people are looking for sort of tea leaves to the labor market, maybe this is a decent one.
Yeah, TD Cowen as a hold here. Results show the company's sustained overall growth is intact. Just looking at RBC, sector performs, so they're a hold too. They say they flag here have a tightened operating margin to the higher end of their guidance range. Not a ton of love on the street, though, actually. Most on the sidelines.
Although the stock is up like 25% over the past year.
All right, coming up, we're going to hear from a strategist discuss how investors should be preparing for the April 2nd tariff deadline. Stick around. Much more market domination. That's still to come. Another sign the IPO window may be opening. Discord, the popular chat app, reportedly has hired its bankers for its long-awaited initial public offering. Bloomberg saying the company is working with Goldman Sachs, JP Morgan. Just last week, our very own Brad Smith sat down with Discord CEO Jason Seifert, who wouldn't directly address the company's plans to go public.
I can't comment on any speculation, but we're very focused on building an amazing product, an amazing service, an amazing company. And that's what gets us, up out of bed every day, just thinking how we can innovate on behalf of our players and create new cool ways for them to talk and hang out with their friends.
Based on data on Yahoo Finance, the current valuation of Discord is roughly $6.6 billion. Company last did a fundraising round in 2021 at $15.1 billion valuation, Julie.
Yeah, that's new data, by the way, that we have on our website that you can look at private company valuations here. We've been discussing so much. Is the IPO window open? Is it not open? This one's going to be the test. No, that one's going to be the test. I guess it depends on which one of these is first to come to market. Will it be something like a CoreWeave, which is scheduled to come public, but there are still some questions about the valuation. Will it be a Discord? Will it be a Klarna? All these companies that we've been waiting for. What we do know is that the IPOs this year, thus far, have been a lot slower and smaller, just like the M&A has, than had been expected.
Yeah, we had venture investors come on who were broadly bullish about the market because they thought the regulatory backdrop was going to get easier because they saw an economy that looked to be on solid footing. But now throw in a market that gets real volatile real quick. How that impacts that dynamic, we'll see.
Yes, we will. UPS is launching a new tool for online shoppers to automatically see the added cost of tariffs that are affecting international shippers. That new service will calculate and guarantee the cost of any levies on products in a shopper's online cart. At checkout, it aims to address a long-standing issue of buyers being handed surprise charges when their international packages arrive. It's an issue that risks becoming more prevalent as President Trump's trade war escalates here. So obviously UPS and FedEx are really struggling with how to price through these tariffs. How do they make them seen? So in this case, UPS has decided to just be transparent here. They've decided this tool is going to be called Global Checkout, which calculates those costs of tariffs and I guess has them as a line item when people are buying.
Yeah, we recently heard from FedEx, which of course reported disappointed, and UPS earnings on deck in a bit. What's interesting is tariffs are one issue, and then to the extent that tariffs impact global growth is yet another issue for names like this.
Exactly. Yes.
Americans aren't feeling great about the economy, and it's translating to a weaker outlook for spending. Consumer confidence clocked in at 92.9 in March. That was its lowest level since 2021, according to the Conference Board's latest survey. And if consumers are uneasy about the economy, that's a real risk, of course, to the market, particularly if Americans start to pull back on spending. Consumer discretionary stocks in the S&P 500 are down 9% from the start of the year compared to the overall benchmark index, which is down about 2% year to date. Joining us now is Matt Bertolini, State Street Global Advisors, head of Spider America's research. Matt, it's great to see you. Let's start with that consumer discretionary sector, Matt. Now, you're, I know, carefully watching. You're looking at flows. You're looking at positioning. What do they tell you about that sector right now, Matt?
It doesn't really tell you a lot of good things. So we always like to look at flows and positioning through different lenses. One, just looking at the level of inflows or outflows. And you've had outflows year to date for the consumer discretionary sector and about 800 million in just March alone. But then because our funds are heavily traded through options, you can start to look at some of the options positioning. We also see some bearish sentiment forming there as well. You see put to call ratios elevated normally than what you'd see historically. You also see their open interest levels geared more towards the put side as well. I think the last one that sort of gives me this hesitation or semblance of bearish positioning is what we're seeing from the shares being sold short on the fund. Basically, the fund entered the year with about 3 million shares sold short. That has doubled. There have been more short bets placed on our fund that covers the consumer discretionary sector, XLY, than we have seen at the start of the year. So there's a lot of bearish positioning into it from a flows, options, and the short market. A lot of it has to do with some of the technicals out there, the macroeconomic data, but also fundamentals.
Well, and fundamentals, I mean, Tesla is a pretty heavy weighting, right, in the XLY here. So when you look at the Tesla performance, obviously that's part of it. So what have you seen kind of, how much has that been contributing?
So obviously we have to pin some of this on Tesla. Basically, if you look at the contribution to a negative return, it equates to about 60% of that negative return so far year to date, even though the stock only makes up 15%. But to only pin it on Tesla is a little bit unfair, because if you look at the underlying sector itself, roughly about 2/3 of the stocks are down this year. And even if you remove Tesla, the sector is down about 3.5%. So it's really a somewhat of a Tesla story, but also what we're seeing from a macroeconomic perspective. Consumer confidence is lower. Inflation expectations are at basically 30-year highs. We see economic data coming out from the Atlanta Fed GDP now, indicating some sluggishness. And then also on the fundamental side, while Tesla's earnings have been slashed, about 87% of the sector's names have had earnings reduced or revised lower for the quarter so far. So there's a lot of things, but Tesla's a part, but it's not the only thing really driving the sort of bearish sentiment.
So that's consumer discretionary, Matt. What about counter-cyclicals? Your defensive, healthcare, insurance. What are you seeing the trends there?
Yeah, we're seeing a little more positive trends. I think thinking about them as counter-cyclicals, but also areas where maybe to hide out from some tariff impacts. Because again, like consumer discretionary, you get a decent amount of revenue from overseas. If you think of things like the insurance industry or healthcare services, their revenue profile is largely quite domestic. They also have more of a defensive nature to them. And again, their valuations are somewhat constructive and growth is looking to be positive over the next couple of quarters. So hiding out in those areas, and insurance, healthcare services, both of those industries are up this year. So that could be one area to look at and sort of navigate the macroeconomic environment that we have right now.
Matt, when you see the kind of outflows, the kind of options activity, the kind of short interest activity like you've been seeing with consumer discretionary, does it tend to continue? Do you sometimes have sort of snapbacks? Like what have we seen in the past with these kinds of situations?
Well, ultimately, there's always a little bit of capitulation. There's so much bearish sentiment that also becomes a reason to act or a reason to buy and step into the marketplace. I think where we sit now, just given what we've seen from macroeconomic data, fundamentals, so the sector's earnings per share expectations for Q1 2025 heading into the year were 11%. Now it's largely going to be flat. And my guess is that's probably going to continue to be ratcheted down as maybe the repricing of earnings expectations comes to fruition with respect to tariffs. So I don't know if we're going to see more outflows continue, but what I do know is that the sort of turnaround, we're not there just yet. I think we need to see those earnings numbers come out. If they are better than expected, that could be a reprieve. But right now, we're sort of trading in this macro vortex of tariff announcements, economic data, and none of those things are ultimately good for the sector or sentiment from that perspective.
What about those sectors that are impacted by tariffs, Matt? I'm thinking like the banks, for example. I'm curious what kind of flows, positioning you're seeing in that sector.
So we're starting to see some turnaround in bank positioning. It was a little bit of outflows to start the month. We've seen inflows over the last few weeks as the sort of ultimate recessionary fears have sort of been put to rest. We do have some sluggishness in economic data, but when we look at the earnings fundamentals of banks, looking at maybe 19% earnings per share growth in Q1, valuations are largely constructive, trading at a 75% discount to the market. Normally it's around 60%, so valuations are constructive. And then again, I just go back to some of the policies. If we look at tariffs, banks largely regional banks generate less than about 10% of their revenue from outside the U.S. So largely, not so much insulated from tariffs from that perspective. Then also you have widening net interest margins that can be beneficial to bottom lines as well. So banks is one of those areas where you can sort of hide out in this sort of macro-driven market.
Matt, we covered a lot of ground in a short amount of time there. Thanks so much for joining us today. Appreciate it. All right, let's get to our call of the day now. That's Bank of America giving Playtika a double upgrade. The note calling the stock a nice house in an undesirable neighborhood, Julie. So the rare double upgrade goes from underperform to buy on the mobile games company. Talk about its unusually high free cash flow yield, highest profitability within the industry, largest DTC platform.
Direct to consumer, right, exactly. And they say also 3 of the largest and longest running franchises in mobile gaming history. They also say that the company's forecast for this year is highly conservative. They say we estimate it implies a 6% year-over-year organic decline in 2025. And they say they don't think that's going to happen. They say this year the company expects to improve its capital allocation, restart growth of its genre-leading franchises, and harvest the long tail of smaller games.
Yeah, in the industry it works in, the mobile gaming industry, they say, yes, it's mature, but it's still growing, Julie. And that's good enough for a buy. While we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for market domination overtime.